The financial information provided in this content is for informational purposes only and not for the purpose of providing specific financial advice. Please contact a financial professional to obtain specific financial advice.
If I mention the name Keith Gill, does anything come to mind? Nothing? How about if I mention one of the nicknames he goes by, Roaring Kitty? Does that ring any bells? You might remember seeing him on the news in 2021, a young guy who broadcasts from his home office, often in a headband and a Game Over t-shirt. Keith Gill is one of the most celebrated stock investors of recent years. He was a social media phenomenon who became famous as the leader of a huge pack of individual stock investors that took on Wall Street hedge funds a few years ago and won. It started when Gill began investing in the video game retailer GameStop, a chain of video game stores that had been in decline for several years. It was widely expected to share the fate of similar brick-and-mortar electronics retailers like Circuit City, Radio Shack, and Blockbuster. Hedge funds were short-selling GameStop shares at the time, expecting to profit as its financial condition worsened. Now, short-selling is the strategy of borrowing shares and selling them today on the expectation that the share price will continue to fall so that you will be able to buy shares more cheaply in the days to come and use those to pay back whoever you borrowed the shares from, making a tidy profit in the process. Of course, if the price of the stock goes up, you'll lose money when it comes time to repay those shares you borrowed. Short selling is risky and controversial, and some claim that it borders on market manipulation. Stock prices naturally fall when there are more sellers than buyers, and if enough big players begin shorting a stock, that fall can become a downward spiral. Particularly if other investors see what is happening, lose confidence in the stock, and begin selling themselves. Under such pressure, GameStop shares had plunged to nearly $1 a share in August of 2020. But Gill wanted to buck the trend, arguing on social media and YouTube that GameStop was undervalued, and posted screenshots of his positions in a Reddit community called Wall Street Bets. His posts gained traction, particularly among millennial investors who were nostalgic for the brand. But it quickly took on a David versus Goliath narrative that rallied tens of thousands of individual investors to invest in the stock to try and beat the hedge funds at their own game. And it worked. By December, GameStop shares had climbed above $5, a 5-year high. Remember that short sellers must eventually repay the shares they borrowed to close out their positions. Now, if the share price goes up, the short seller is often able to delay having to do this, but that usually requires them to pay interest on the borrowed shares in the meantime. This means that raising the price of a stock over a few months can be expensive, but not necessarily catastrophic if the short sellers believe the price rise is just temporary and choose to wait it out. To hold their feet to the fire, Gill and most of the community refused to sell even after the price of the shares rose significantly. They purposefully created what's known as the market as a short squeeze. In this situation, persistently rising prices will cause short sellers to start to panic and scramble to find and buy shares to close their positions, fearing the prices will continue to go up over the longer term. This frantic buying will cause the share prices to rise even further as demand outstrips supply, causing more short sellers to panic and try to exit their positions. So the situation turned from a downward spiral to an upward spiral. During January 2021, GameStop shares soared more than 1,500%, reaching a peak on January 27th of nearly $500 a share. The upward trend was helped by news reports and tweets from celebrities about the short squeeze, and tens of thousands more investors joined the Wall Street Bets community to take part in stock market history. And the value of Gill's investment reached close to $48 million in this period, according to news reports. Not bad for a guy who had been doing marketing work for the life insurance company Massachusetts Mutual and investing in his spare time. Keith Gill's story is compelling because it's about an individual investor who won big in the stock market. Let's face it, we'd all love to have that kind of success. If you invest in the stock market as well, you must have thought about what it would be like to pick that special stock or mutual fund that made you rich. I sure have. So let's not be shy about asking the question that all of us want the answer to. What does it take to get rich in the stock market? We're going to think seriously about that question and try to come up with some answers. Because while the Keith Gill story provides intriguing insights into the behavior of the stock market, we need to ask ourselves, does it provide a model for investing? Maybe you're asking yourself, do you have to be exceptionally lucky or exceptionally skilled to make a fortune? Or is it possible for average people to strike it rich in the stock market? Now, I could spend an entire course just on the stock market and all the different theories and strategies people have used to try and master it. But in this lecture, I want to focus on just a few core concepts that I find most powerful for those trying to understand it in a broad sense. To start with, there is one fundamental fact about the stock market that affects the investing landscape for almost every investor. And that is, in the words of a former colleague of mine, the stock market is pretty darned efficient. The term market efficiency has a special meaning in the stock market due to a famous but controversial idea called the efficient markets hypothesis. It's associated with the Nobel Prize-winning economist Eugene Fama, and it states that stock prices reflect all the information that's currently available. Competition causes the stock market to behave like this. If we have a market full of investors and traders who are all trying to get rich by picking the best stocks, then they'll use all the information they can find to get an edge over other investors. And they will act on this information by buying the shares of companies they think are great and selling the shares of companies that aren't. This competition leads to buying and selling based on information, which in turn ensures that prices fully reflect the currently available information. Now, the word currently is key because although it might not sound very important, it implies that the only thing that influences stock prices from day to day and moment to moment is the arrival of new information that people haven't previously anticipated. And because of that, stock prices will be inherently unpredictable. Because life is unpredictable. Every day, every moment, new things happen, new information is received, and the unexpected occurs. But if stock prices are unpredictable, then it's going to be nearly impossible to be a successful stock picker, isn't it? How can anybody expect to get rich in the market? Well, you can get rich picking stocks if you get extremely lucky. Anyone who bought into GameStop right after Keith Gill's advice and then sold at the height of the market a few months later would have made a fast fortune. And while those overnight millionaires might now claim some brilliance behind their investment, in reality, there was no information available in the months prior that could have predicted for sure how the GameStop saga would turn out. As the story gained traction and the future became clearer, of course, tens of thousands of people jumped on the bandwagon and bought in. But those who bought in later at higher prices made a lot less. And those who bought near the peak likely lost, because over time, GameStop shares adjusted to the new information and even out to a sustainable level. And plenty of people who could have made a great fortune didn't, because they held on to GameStop shares thinking they'd keep rising, and they held on too long. The overnight millionaire scenario usually only occurs when there's a huge discrepancy between the information available today and tomorrow, precisely because the vast majority of investors were not able to foresee something coming. Wall Street Bets is aptly named in this case because everyone was essentially gambling on very uncertain future information. Just like you can't know for sure what card the blackjack dealer will draw next, no one could exactly know how the GameStop story would end. But even though the future is unknowable, it is not inherently unpredictable. Information available today generally provides a solid basis for predicting what will happen tomorrow, and thus provides a basis for making smart investing decisions that will make you richer over time. And this is where the line starts to appear between gambling and investing, and it's the case for any market you want to buy into. Gambling offers the promise of big or quick payouts, but it's far riskier and you're relying on very uncertain future information. Investing focuses on the future information that we can predict with much more confidence. That usually means much more modest returns, but at much lower risk, especially over the longer term. Now, the efficient markets hypothesis comes in 3 different versions, and I've described the most extreme or strong version because it's easiest to understand. But very few investors or economists believe this version of the hypothesis. Other versions of the hypothesis back away from the claim that stock prices reflect all available information. They state that stock prices reflect a lot of information, but not all of it. The weak version of the hypothesis states that stock prices reflect all past information, and that seems sensible. But it's the second version, the semi-strong version of the efficient markets hypothesis, that I think best describes the reality of the stock market. It states that stock prices reflect all publicly available information, past and present. This is a lot of information, but it still leaves out what financial economists call private information. Private means that some people have the information, and in some rare cases, perhaps only one person has it. The existence of private information means that some people might possess information that is helpful for predicting future stock prices, so that they can pick winners and buy in early and cheaply. If that information becomes public, of course, every other investor will try to do the same, and the advantage will be lost. So the semi-strong version of the efficient markets hypothesis suggests that one way to get rich in the stock market is to get a hold of private information and use it to gain an edge over other investors to get rich. Now at this point, you might be asking, hey, isn't that insider trading? Is Connell Follenkamp telling me the way to get rich in the stock market is to break the law? Of course not. Only a subset of private information is off limits because of insider trading concerns. What might make it off limits is your relationship with the provider of the information, not the fact that the information is private. If you obtain private information because you work for or with a company, or get information from the employee of a company and use that private information to make stock trades, then you run the risk of being charged with insider trading. But there's another way to get a hold of private information that's completely legal. You come up with it yourself. You study a company and make your own judgment about its value and your own predictions about how it's going to perform. You use your own understanding of how stock prices are determined and your own assessments of market conditions to decide whether a stock is worth investing in. All of this is private information. The semi-strong version of the efficient markets hypothesis states that stock prices don't necessarily reflect all private information that's being created daily. But here's the thing. The market is already full of professional investors who earn their living from developing their own private information about stocks and trading on that basis. They spend all day evaluating companies. That means there's a lot of competition to come up with better private information. And as a result of the trading motivated by that information, it doesn't take long before someone's newly discovered private information is reflected in stock prices. This is why I say the market is pretty darned efficient. Yes, there are opportunities to make big money by developing private information that is better than other traders' information. But it isn't easy, especially for individuals. Not that individual investors can't do it. In fact, there are many successful individual stock pickers. And individual investors do have some advantages over professionals. For example, we're often able to buy stakes in companies that are too small to be attractive to the big end of town. That said, I still think being a successful stock picker takes a bit of natural talent and a lot of effort. There's a steep learning curve before you develop the skills to pick stocks confidently. And even then, success is never guaranteed or permanent. So yes, it's possible to get rich in the stock market by picking your own stocks. But you can't get something for nothing. You have to dedicate time and effort and take on risk. On the bright side, there are lots of resources available to help you, including another great course I made called Understanding Investments. In addition, I think it's possible and a good idea to learn from some of the many successful stock pickers out there, such as Warren Buffett or Peter Lynch. You can do so through their writings and public statements, or by way of the many things that commentators have said about them. Some of these insights can help you develop your own investing philosophy and style. And that brings us back to Keith Gill. I've watched 2 of his Roaring Kitty videos on YouTube in which he describes his investing strategy. It's clear from his discussion that he spends a lot of time gathering information on companies and from other investors. Gill claimed to be what's called a deep value investor. He describes his favorite type of company as one that was experiencing financial difficulties but not bankrupt. And wow, that explained for me why he got involved with GameStop and other out-of-favor stocks. He also offers some good tips for any investor. For example, he emphasizes the importance of looking at insider share purchases. These are the purchases of company stock by the CEO and other officers. Because they probably know more about a company than anyone else, their willingness to buy shares can be a signal about the future direction of the enterprise's stock price and private information that they may have. Of course, what Gill could not, and by his admission did not predict, was the tidal wave of investors that poured into GameStop overnight and sent the share price soaring. And some very prominent critics of the efficient markets hypothesis, like behavioral psychologists, have pointed out that cases like GameStop show why the market doesn't necessarily track available information in all circumstances. Because while Gill may have had solid, well-researched reasons to invest in GameStop, many of those who ultimately invested did not. Some were driven by nostalgia, sympathy for an underdog, dreams of getting rich, or even just fear of missing out. Tweets about the short squeeze by celebrities like Elon Musk drove thousands to invest with barely any experience or knowledge of the market at all. The fact that GameStop's shares rose so high, far higher than its financial performance or underlying valuation, is an example how, at least temporarily, the market doesn't always operate on complete or accurate information. Seeing the unpredictability of share stories like this one, another famous investor named John or Jack Bogle believed in a totally different investment strategy for getting rich in the stock market. Bogle is considered the father of index funds and passive investing. He was the founder of one of the world's largest investment advisory firms and mutual fund companies called the Vanguard Group, which still operates today. And it was his view that although individual stocks will go up and down unpredictably, the stock market as a whole is pretty darned efficient. And so it was the market, rather than individual stocks, that people should invest in. Bogle believed that even the most talented and experienced stock pickers would tend to underperform the market average, and virtually no stock picker could beat it consistently. Legions of economists have tested this proposition, and it's amazing how consistently the evidence supports Bogle's wisdom. Dozens of famous studies have found that even just randomly selecting a set of stocks to invest in tends to do better than following the advice of seasoned market experts. Not only that, but you pay those experts a percentage of your portfolio's value each year for the privilege of underperforming the market. To Bogle, that was just foolish. You literally lose twice, once by underperforming the market and an additional loss from the management fees. The lesson Bogle took away from this is that the most reliable way to get rich is to avoid trying to pick winning stocks altogether. So he and Vanguard created the first index fund. This fund would own shares in every company of a particular index, such as the S&P 500, which is an index of the 500 largest companies currently traded on American stock exchanges. And investors like you and I could buy into these funds without having to buy shares in all those companies individually. An even broader market index is represented by Vanguard Total Stock Market Index Fund, which invests in thousands of different stocks in an attempt to track the market as a whole. The only picking an index investor needs to do, Bogle argued, is to find the portfolio with the lowest management fees, because those periodic fees add up over time and can significantly reduce your overall return. So we've gone from one extreme with Wall Street bets to the other with index funds. But can a person who follows this much more conservative advice still get rich from investing in the stock market? Well, let's spend a little time making the case. Under one scenario, a person could get rich this way if the value of the stock market rises quickly enough and consistently enough to turn small amounts of invested money into significantly larger amounts. Over many years, the stock market would make a person rich through the power of compound returns. So $1,000 invested today and increasing in value by 5% a year will grow to more than $10,000 at the end of 50 years. Make it $2,000 invested annually over a period of 50 years, and the sum grows to nearly $420,000 by the end. And that's conservative because the stock market's average return is closer to 10% a year than 5%. Well, these numbers sound great, but they assume that the market delivers at least a 5% return year in and year out. But we know historically, stock returns have been all over the place. There have been crashes like the one in 1987 that shaved off about 20% of the market's value in one day. And there have been bear markets that lasted for years and ground down the value of stocks by a few percent annually. So, can you still get rich from Bogle's strategy of passive investing when the market behaves unpredictably? In my opinion, the answer is still yes, but a qualified yes. If you give the market enough time, hanging in through the bad years and the good, then passive investing can still make you rich. The value of the stock market follows a long-term trend tied to the growth of the overall economy because the companies listed in the stock market constitute a big part of the economy. But there's a lot of noise around that trend, and the scary part is that the noise sometimes drowns out the overall upward trend. Let's think about some historical examples. From 2007 to 2009, during the subprime mortgage crisis, the market was highly volatile, culminating with a drop of nearly 40% in the value of the S&P 500. That was pretty scary to most of us who lived through it. It was a setback for everyone who invested any part of their wealth in the stock market. And put yourself in the shoes of somebody who was about to retire in 2009 and think about what a disaster that decline must have been for their finances. The question, however, is how much of a setback did it turn out to be? Well, let's zoom out to the closing price of the S&P 500 over a much longer time span. Consider 40 years of daily prices from 1983 through 2022. In that context, the market collapse of late 2008 and early 2009 registers only as a brief dip. Overall, there was an obvious upward trend in the value of the stock market, and in the years after 2008, the stock market not only recovered, but went on to higher values within a few years. Just like picking the right company to invest in, picking the right year to invest in is pretty much impossible. There's just too much that we don't know about what will happen in the future. But keeping your money invested over the long term spreads out the risk. The longer you stay invested in the stock market, the less any individual dip matters. This suggests that you really can get rich in the stock market simply by investing in passive market index funds. But you still don't get something for nothing. The cost of getting rich is measured in units of time. You need to be able to leave your investments alone long enough to benefit from the underlying trend, and to recover from any of the dips and crashes along the way. And as you can imagine, the timing of the crashes and the recoveries doesn't necessarily match the timing of your plans. To me, this is the main challenge to investors who want to take the passive route to getting rich in the stock market. You need to be prepared to deal with ill-timed drops in the stock market just when you might need to sell some of your stock holdings to cover a major expense. While this can be a fact of life throughout your earning years, it can also affect you, perhaps unexpectedly, in retirement. This happens because people whose retirement savings are tied up in tax-deferred investment retirement accounts in many countries often require minimum distributions on a periodic basis. In the United States, for instance, the Internal Revenue Service requires you to withdraw a minimum amount from each of your tax-deferred savings accounts every year after the age of 72. Required minimum distributions mean that you might have to withdraw a significant amount from your stock holdings right amid a big drop in the market, when you'd much rather leave the account alone so that it can have time to recover in value. Or if you're reliant on investment accounts to live off of, or pay for health expenses or something unexpected, you may be forced to take a significant hit if the market is down. Still, the long-run trend has pushed stock prices up for decades, and in my opinion, it will continue to do so as the economy continues to grow over the long term. So there you have it, 2 different strategies for getting rich in the stock market, each of which is accessible to individual investors. Not that either path is easy. This raises an important final question. Can these strategies help you even if you can't follow them perfectly? I think the answer is yes. For both strategies, information is critical. The market runs on it, and every serious investor strives for it, and the more you can get, the more you can maximize your chances for success. But no matter how much information you have, the active strategy is the riskier one. Picking winners that perform above the market average can net you more profit, and if you happen to make that perfect pick at the perfect time, like Keith Gill did, you can turn thousands into millions. But then you verge on gambling, because there's just so much information that is inaccessible or unknowable. And if you pick your own stocks without knowing what you're doing, you might inflict serious financial reversals on yourself. The passive strategy is the safer, if less exciting choice. You won't win the lottery that way, but history has shown that the longer you leave an index basket of stocks alone, the better you'll probably do. So what became of Keith Gill after his tremendous run with GameStop stock? State and federal securities regulators investigated him, and he testified in front of Congress. But he wasn't charged with violating any laws or regulations. He quit his job with MassMutual in January 2021, and a few months later, he stopped posting to Wall Street Bets and YouTube. It seems that Keith Gill did get rich in the stock market. And then he did what a lot of us would do. He retired early. But if you're still out there building up your private information picking stocks, Mr. Gill, I wish you all the best.